Understanding Auditing, Introduction of Segregation of Duties. This is Ken Boyd, the owner of St. Louis Test Preparation. Here is our email address and our phone number, and you'll see our website later on in the video. Auditing, the most challenging of accounting topic. Auditing is unique when compared with other accounting courses that you take in college. And here's why. While many other areas of accounting are based on rules, principles, how you present financial statements, when you recognize revenue, accounting's different. Accounting emphasizes procedures, what you do, how people act, how things come together. There's more testing and there's less report creating. And examples in teaching auditing are critical. The only effective way to teach auditing is using examples from actual businesses. There's really no other way to teach it effectively. And I've always thought that accounting should be the best, auditing should be the best accounting class that people take. And probably the most important concept in auditing is segregation of duties. So let's define it first. It really means dividing responsibility. These three tasks should be performed by different people where possible. Now, we realize in small businesses this isn't always possible. First of all, physical custody of assets. Who has the stuff? And by the stuff I mean the checkbook, the vehicle keys, access to the office, stuff that has value, assets on your books that have value. Who can authorize a transaction? In many organizations, the larger the check that's being written, the more people have to approve it, and the higher level of authority that people have who are approving the check. Finally, who records the transaction? For example, if there's something suspect going on with the checking account, if someone independent of that activity reconciles the checking account, they might notice it and catch some fraud that might be going on. We'll see that on a later video. Well, what if you don't segregate duties? Well, you're subject to several risks, one of which is fraud, which is defined as willful intent to deceive, intentionally deceiving or fooling somebody. When one individual has 2 or 3 of the duties listed on the prior slide, they may be in a position to deceive the company and steal property. And that property is not just cash, but also inventory, equipment, vehicles, company secrets, and on and on. Negligence is less serious. This is just stupidity. If the duties aren't segregated, the company may incur loss just out of simple neglect, incompetence. Property might be lost, accounting records might be incomplete, goods might be ordered without proper approval. You may order too much of something or something you don't need if you simply don't have these procedures in place. Types of risk. Collusion. You may have heard about it if you're a baseball fan, that we had a collusion case in baseball years ago where the owners were accused of collusion. What does that mean? When 2 or more people work together to commit fraud, we saw that on the prior slide, to willfully deceive the company and steal assets, that's called collusion. Unfortunately, segregation of duties, the best procedures and the best division of duties in the world cannot prevent all collusion. An example is fictitious payee. Companies should have an approval process for paying invoices. It is possible for someone to create a fake invoice, get it approved for payment, and send a check to an address that they control to basically fix or rig the process of writing checks and paying bills. Theft of equipment or other property. Many businesses need to allow workers to use equipment off-site. For example, think about the plumber, any type of repairman driving around a truck with lots of expensive equipment on it. They work at the client's location. In this environment, it may lead to an employee committing theft. Maybe the plumber takes some of the equipment off the company truck and uses it to do plumbing jobs on the side on his own, outside of the company's normal work hours. Reimbursement in excess of cost. Many people turn in receipts at work for expenses they personally incurred. The company reimburses the worker based on receipts. If the employee deceives the company to pay them more than they're owed, that's also theft. Our bibliography, some of our definitions came today from businessdirectory.com. That's the end of part 1 of auditing. You'll find part 2 on YouTube. For live tutoring, including tutoring on the CPA exam, live chat sessions, go to our website, www.stltest.net. We think there's a real need for teaching auditing and particularly giving real-life examples later on in our course because we think it's something that's neglected and for a lot of people who are in college and also studying for the CPA exam. Thanks very much. We'll see you next time.